DATS as a boost for the market or boost for the asset prices is pretty much over in my view.
What's up, everybody? It's LG Doucette here, and welcome to the Milk Road Show, the daily crypto show that reads the market's fine print so you don't accidentally buy the footnotes. Today is December 10th, 2025. We are recording on December 9th, 2025, although it is December 10th for our guest today. We had a conversation earlier on the show this week about chain valuations, and we didn't really get an answer in terms of what makes a chain actually valuable. TVL just doesn't really cut it. But today's guest has a metric that he himself has coined, and it might just be the closest thing we have to understanding which chains are over or undervalued. Jamie Coutts, the chief crypto analyst at Real Vision, is our guest today, and we will discuss his research piece on L1s and also kick off by discussing how he kind of foreshadowed the current price action on Bitcoin and what might be coming soon that may not be so good for Bitcoin and why he is a little bit worried. Today's episode is brought to you by Reserve DTFs. Get exposure to the entire crypto market in a single token. Chainlink, break the interoperability barrier and power the future of tokenized finance. And Bridge, power your business with instant stablecoin payments, no friction, no banks, just global finance made simple. Here he is. Jamie, welcome back to Milk Road, man. How you doing?
Yeah, I'm doing well, LG. How are you?
I'm good, man. It's great to finally chat with you. I have not interviewed you. You were on with Jay last time, but I do have one pretty big question for you. Last time you were on the show, you said Bitcoins and altcoins were set to explode in Q4. That obviously hasn't happened. It has surprised all of us. What has changed? What in your opinion, prevented us from reaching, I guess, Valhalla by this point?
Yeah, it's certainly been a disappointing quarter. There was a report that I published back in September, which was just after really the market made, or Bitcoin made new highs. And in that report, I was forecasting that Bitcoin was likely to decline by about 25 to 30%, a very normal decline in a typical bull market for Bitcoin. The reason for that was that you could see that momentum in global liquidity, depending on which metric you're looking at, was starting to roll over. And that's a huge driver of asset prices. But what's happened since has definitely surprised me, because I was expecting that we would have inflected higher again by now. And we potentially are. If you look at the technicals on Bitcoin and some of the digital assets, that they've started to look like they've put in a bottom. There's some technical indicators like DeMark that have shown exhaustion around these levels. So maybe that's happening. What has definitely surprised me, though, is that the pullback was deeper. And the size of the liquidity withdrawal was larger than expected, and it came from sort of different places than I thought. Namely, what the TGA did, or the Treasury General Account did with the Fed, in terms of sucking up liquidity from the market and then going into a shutdown. So those things were definitely unexpected. The things that I was worried about at the time, which was causing the rollover in liquidity, was more around the Fed's balance sheet. And in the report, I was forecasting that they are going to have to end QT. And at that time, no one was talking about that. But they actually did surprise the market, I believe, and flag that last month. The question, or the bigger issue for our favorite digital asset, is that it doesn't seem, even after today's announcement that there's a resumption to balance sheet expansion, that it's going to be enough, given the state of reserves in the financial system. And I think that is really continuing the really subdued price action that we're seeing. So the outlook for next year, though, if that was going to be the next question, is that we're going to see liquidity resume higher as a function of the fact that QT has ended. The Fed is now, I think it's around 40 billion. The announcement just came out before we went on this call, LG, so I'm not sure if that number's correct. I think it's around about 40 billion in asset purchases, which I think is the inverse of the QT program that they were running, which ended. So they've now flipped it. So it's almost like an 80 billion net positive to liquidity. Then you've got the SLR changes, which the administration is trying to push through quite fast. So that will add to global M2 next year. The question is the ascent, or is the change in liquidity enough to fully support asset prices, especially those assets which are seen to be the debasement trades, or the debasement anti-debasement trades, i.e. gold and Bitcoin? I think it's going to be very good for equities, There's definitely lots of tailwinds happening for equities. Corporate earnings are expanding, so the S&P should grow into sort of its PE multiple premium that it's given itself over the last year, and there's a ton of capex to go through. But I think it's the debasement assets like Bitcoin, and I wouldn't put the rest of crypto in the debasement trade because they're really technology plays. So they tend to perform very, very differently, but they are also caught up in the sort of the beta on Bitcoin. But my view is still we get a decent push higher next year. I think the market is just trying to digest what the Fed has actually said in this most recent announcement, or what Powell was saying in the press conference today. Always mixed, there's always mixed signals from these guys. I mean, it's actually infuriating to watch, the Fed officials talk about monetary policy because it's clouded in so much confusing language, which I think is there intentionally. But essentially, what we've seen is a cut. We've seen balance sheet expansion, but the question is it sufficient to really drive assets higher? So that's been the disappointing element to why I think digital assets have really underperformed this quarter. We can talk about the structural drivers for adoption, the Clarity Act, and all those things that make the asset class extremely attractive over the medium term. But I think at the moment, everyone is squarely focused on what's happening on the liquidity front.
I'm going to pause there for a second. If you're listening to this and thinking, okay, but what is the move I should actually be making? Then Going Pro is for you. Every week, our research team drops a full deep dive on the biggest themes everyone else misses. Plus, you get access to our full Milk Road Pro portfolio that has real-time buy and sell signals, and access to our Discord where our analysts will answer any question you have. If you want to level up, honestly, that's where you got to do it. Hit the link below. Is the crypto market like structurally dependent on liquidity intervention? Like, because it feels like obviously it needs liquidity to thrive and to function, but it feels like we keep hedging our bets on like, well, the TGA is going to unleash all that money, or we're going to change rates and this is going to happen. I feel like it's so dependent on having some kind of infusion of money in this interventing kind of way.
Yes and no. I mean, there's the thesis that I've always maintained for why you want exposure to digital assets and why it deserves a place in anyone's portfolio, like a global portfolio, a multi-asset portfolio, is that there are two secular themes of our time which are unshakable. And that is the fiat monetary order is a credit-based system. And we're at a point where every new dollar or new currency unit of credit that's created produces less and less economic output or value. And that the size of the outstanding debt is so large that really all we're doing right now is issuing more credit to service the existing debts. And that is a system that is, extremely impaired and is irreversible mainly. So therefore, the debasement aspect, which is what they do to try and keep the system afloat, lends itself to debasement, anti-debasement assets, gold, and also Bitcoin, the newer form of that. I mean, Bitcoin's got, different utility and different properties in gold that make it quite unique, but they're essentially in the same basket. The other major secular trend is technological adoption. If technology improves people's lives, it will be adopted. It never regresses. So that aspect of blockchains and what they provide to a already, a archaic financial system and a world in which trust is being, destroyed by our institutions, decentralized or trustless or more neutral platforms for doing commerce make a lot of sense. So I see liquidity as being a structural driver, but more of an amplification of the technological adoption trend, which is driving blockchain, driving robotics, driving AI, genomics, all these other exponential trends at the moment. So we live and breathe, in large part based on what the central planners are doing at the monetary and fiscal level. But, my phrase is, the spice must flow. Nothing stops this train from Lynn Alden is, a more well-known saying. Like, it is liquidity is the the circulatory necessity of the entire system. So over the medium to long term, it doesn't really matter. It's going up. And the technology and the adoption of the technology to solve other issues other than just a store of value, right? The other issues are how do we move value? How do we amplify monetary velocity that is, has been cooked for years, for decades, really, because all the system does is print new credit to buy assets. I mean, up until recently in this new CapEx cycle, most credit was being issued to institutions to invest in financial assets. And so the economy has been sort of languishing for decades under that sort of regime. Blockchains, smart contract platforms are the new infrastructure which allow monetary velocity to reinvigorate, reignite. And let's face it, I mean, there is a desire for half the world's population to get access to financial assets, to credit, to be included in the financial system, that the existing system, as much as it might try or not try, will never be able to service because the rails are broken.
Good answer. I want to ask you, Jamie, about DATs and kind of their role. You had mentioned in that report back in September that their bid might be in decline or might be slowing. Do you think we're kind of getting close to the end of the era of DATs and them added and Bitcoin being added to the corporate balance sheet, or will that be a big part of this 2026 potential run?
So we're definitely at a point where DATs as a boost for the market or boost for the asset prices is pretty much over in my view, because they can't. Most of these DATs are not able to tap the equity markets anymore because they don't have enough premium in their price. Now, they will continue to do so until such time as the market prices them back at MNAV of 1 or even less. The ones that will continue on are the ones that have successfully tapped fixed income markets and are able to continue to inspire trust. And that really comes down to size and also the quality of the management. And there's only a few companies in each of the digital assets that actually digital asset companies or treasury companies, that can actually pull that off. And so you're going to see consolidation. I was never really a huge fan of this whole strategy from MicroStrategy being broadened out, because it was always going to inspire lesser or lower quality companies from pursuing it. And the market would always consolidate around the best quality ones. The thing that surprised me is that how quickly the market turned and the sentiment changed. Like, I was expecting that to happen really next year, but it's already starting to get priced in, which makes the MSCI index proposal so fascinating. But just to sort of go back to your question about, is it the end of Bitcoin on the balance sheet? I think it's the end of the sort of the digital asset strategy being the sole strategy. I think it's going to not end the notion that if you've got a business and you've got excess cash flows, that you invest in the best quality asset or store of value, and that would be Bitcoin, but not make your whole business around Bitcoin, the asset, that you continue on as an operating company that's just solidifying your balance sheet, but just these singular focus sort of digital asset companies. I think for now it's really a consolidation game and concentration game, and the ones that are left will continue on to be I think fantastic companies in the future.
ETFs provide investors with a structured, disciplined, and diversified approach to crypto, which is cool, but the world is moving on chain. We need a crypto native equivalent. That's exactly what Reserve's decentralized token folios, DTFs, bring to the table. Reserve DTFs are rule-based baskets of crypto assets packaged into a single token, like CoinMarket's CMC20, crypto's version of the S&P 500. Go to milkroad.com/reserve to find out what's on offer. Sure, tokenized financial products are the future, but there is a big sticking point. They all need to speak to each other. This is a tough problem to solve, but Chainlink does exactly that. It's the universal language for financial markets, linking Wall Street to Web3, banks to blockchain, and so much more. See how Chainlink is linking the world by going to milkroad.com/Chainlink. So hold on, let me recap that. So are you saying that despite a lot of the Ethereum DATs being kind of just copying MicroStrategy, that some of them, you're hopeful for some of them that they can continue to evolve as businesses? Is that what you're saying?
Yeah, I definitely think so. I just think that the tail got too long, right? I mean, there's just too many copycats, and there's only so much the market can absorb. So you're already seeing, you saw it pretty quickly, like a lot of these Johnny come latelys, or even the lower quality asset DATs, immediately started trading below MNAV. I mean, the market is the arbiter of truth, or the best sort of signal, and the market was repricing these assets pretty quickly. So I think, for those that have scale, have good management, I think they're fine. Index inclusion decisions aside, these are productive assets. What MicroStrategy has done by building up a US dollar reserve to pay the dividends on all its preferred instruments, and flag that it's going to really start issuing credit, or start potentially using Bitcoin as collateral for lending, is the thing that I thought would always happen, but I think has been accelerated by the pressure that MicroStrategy has been under to start utilizing the asset. But these are productive assets that will generate yield. In the case of other digital assets, such as Ethereum or Solana, there is, some of these DATs will obviously deploy the asset into DeFi pools and collateral, and they'll be able to earn yield from that, and that will inspire confidence in the ecosystems. But some of them are already actually flagging that they're going to invest directly into other protocols and into other businesses that build inside their ecosystem. So, these are operating businesses, just very different to what the MSCI seems like they would prefer, which is arbitrary, I think, to put it lightly. But yeah, no, I'm confident in that. I just don't think that the ability for them to trade significantly above MNAV is going to persist. And the ones that will do rather well will be the ones that have built up a significant reserve, a significant store position in their assets, deployed that, started earning yield, and are also able to tap fixed income markets. And that's really only going to be a select few.
You mentioned MSCI, and we've discussed that a few times because that's been a hot topic around MicroStrategy. But I'd love to hear from you, Jamie. What exactly is happening with MSCI, and how is that a danger to MicroStrategy?
Well, I mean, the MSCI has put out a consultation paper to exclude digital asset companies if they hold more than 50% of a digital asset on their balance sheet. Now, they're claiming that these are not operating companies, that these are essentially funds. But it seems extremely arbitrary because, they're not penalizing other companies that have more than 50% of their assets 50% of their balance sheet in some other asset, right? Whether it's property for, real estate companies or some other asset. I mean, goodwill is 70% of the MSCI's own balance sheet. MSCI is a listed company. I mean, goodwill is the most ephemeral sort of asset there is. I mean, it's a total intangible. Bitcoin is a transparent asset. It is the new digital collateral, and it is being heavily pushed by the US government, and it's being adopted at sovereign level all around the world. So, it seems rather discriminatory, and also this 50% level, is going to be very hard to adjudicate for an index manager or for the companies themselves. So it seems very ill thought through, or it's on purpose. If you want to take the conspiratory angle, it's on purpose. They just want to penalize Bitcoin companies for whatever reason. But to my earlier point, the market was pricing these companies anyway. If the market decided that MicroStrategy had no value, or if the market decided that Bitcoin had no value, if Bitcoin is in the index, it would fall out. Sorry, if MicroStrategy is in the index, it would fall out of the index, right? The market will tell them. They don't need to overlay their own arbitrary view on what is an operational company. And to my earlier point as well, MicroStrategy has a software business. Bitcoin is going to provide credit. So they're essentially becoming a financial institution in the digital economy. Blockchains are being adopted. Stablecoins are going to grow from 300 billion to 3 trillion within the next 3 to 5 years, according to the US Treasury Secretary. So what are they doing? But, I can't speak to their motives.
You tweeted last week that we may have hit a turning point in MicroStrategy and Bitcoin, in that we are kind of coming up. And I think you were referencing, I guess, their ratio together, but I'd love for you to kind of explain that. And also what's driving that rebound, because this week things feel a little bit positive. We're seeing bids on alts and other things, and we'll get to that later. But I just want to wrap up this point for MicroStrategy and Bitcoin and what you think is maybe showing a little bit of signs of life.
Look, if you look at the technicals, the exhaustion, there was exhaustion indicators in terms of some of the oscillators, but also DeMark indicators that I use on MicroStrategy, but across most digital assets after some pretty hefty declines. And then you got some interesting reversal candles on large volume, which we saw on MicroStrategy last week as well. And that sort of indicates that a potential bottom is in for the short term at least, and that it needs to basically break out, do a few more things on the upside to sort of clear some technical levels. But you look at the ratio between MicroStrategy and Bitcoin, we're at lows that we saw back in 2022. Now, I said in that report, just to be perfectly honest, that I think the ultimate low could be around 120 or 130 on MicroStrategy. But that is that's pricing in a Bitcoin bear market, which would see Bitcoin down at sort of like low 70s. Now, I think risk reward over time, Bitcoin is looking really attractive at these levels, and then where it was a couple of days, when I put out that tweet, which was sort of low 80s, because I think, your downside, if this is a normal sort of bear market, if you want to call it what we're in now and not a mid-cycle pullback, the low 70s look like a pretty decent support level. And then you've just got a function of like where global liquidity has to get to over the long term and take the beta on or take the elasticity of what Bitcoin does when liquidity rises, which is, between 6 and 20 times, depending on the type of environment we're in, Bitcoin will move. So 1% on global liquidity, 6 to 7% in normal times, 20% in really bullish times. And that just means that, we're looking at, a risk reward scenario where, it's at least sort of 1 to 5 over the next sort of 3 to 4 years.
Okay. I like that. I don't know. We have so much incredible research that comes across the show, and I think we're really at an interesting point of like, will we go down a little bit lower there, kind of like what you're saying, into this Bitcoin bear market. It's interesting you're saying that Bitcoin would go into a bear market and that you're not considering this current phase of bear market. Is that correct?
So my view is that we are in a sort of mid-cycle pullback still, because liquidity is going to rise next year, and I think the Bitcoin sensitivity to liquidity, even though it's really lagged it so far, I don't think that changes over the medium term, right? So you get these wriggles where, Bitcoin doesn't react, but then eventually it has to catch up. And I think, what you're seeing with adoption at the sovereign level, Bitcoin mining now driving a lot of energy grids or being used to mediate some of the energy grid issues that certain countries have, as well as now an adjacent industry to AI because of the way it can sort of intermittently turn on and off. Then, what you've got all these significant drivers that come through but are not playing out right now because of like the liquidity aspect. They catch up, liquidity, the responsiveness liquidity eventually kicks in, and then Bitcoin goes a lot higher. But I'm prepared to be wrong on that. I think if this is a bear market and we're still yet to finish the cycle on the downside, I would, and I don't think this is controversial, I would say that the low should be around 70,000 because that was the previous low. And if you look at that was the previous high from the previous cycle. It's also where a lot of volume traded last year. Remember that sort of 30% decline that went on for like 6 to 7 months, which felt like an eternity. A ton of volume traded through there. If it breaks that would be potentially, if it broke there, it would be a change to the cycle, change to the market structure for Bitcoin. The last time that happened, where it broke the previous cycle high, was obviously in 2022 when FTX happened and it broke 20,000 and went down to sort of 16, 17. So I think in my framing, there would have to be some sort of event that would, credit event, maybe a DAT or something that would push it below those levels. But that's definitely not my base case. And then just sort of on a risk reward, it looks pretty attractive from here.
As you guys are listening to the show, you know that there's something hanging over the entire economy, and that's AI. And the problem with AI content is that almost no one explains what the news actually means for investors. Our new AI newsletter fixes that. Twice a week, we break down the moves, the winners, the risks, and where the puck might be going. If you invest in tech at all, the link is in the description below. Check it out. Let's talk about other assets than Bitcoin, Jamie. You also wrote a great report recently about chain valuations, and that you had pretty much come up with, I guess, your own potentially proprietary metric for evaluating how much L1s are actually worth. And obviously that has been a huge debate on crypto Twitter and in the space lately. We had Nasib on this week to give us his take. His best metric was that TVL and maybe daily active users were the only thing that we have, but you have one called ENI, Effective Network Intensity. Give us a little breakdown of what that is and why you think it measures a chain value so well.
Yeah, I'd be happy to. So, I've been meaning to do this for such a long time, but this was really the first part of a series of research papers that I plan to publish, to try and build out a far more complete and comprehensive overview of how to value smart contract platforms. It's by no means perfect, but firstly, it recognizes, in my view, that there is credence to the view that smart contract platforms are priced to some part on Metcalfe's law. So the value of the network is proportional to the number of nodes on the network. Now, what happened in the early days when this was sort of proposed, and this has been a theory and a model that's worked really well for other technology companies over the years, for telecommunications, for internet companies, social media, and so forth. But when it was applied in the first iteration, and Rao was very early on, like many years ago, talking about this, but it was published in academic papers and whatnot. What they did was they used daily active addresses and settlement values as really the components of the Metcalfe's valuation. Now, in the early days, Bitcoin is essentially a transfer mechanism, right? A monetary system that allows you to transfer Bitcoin. It doesn't do anything else. So it's a very one-dimensional monetary network. And Ethereum in the early days, even though it was smart contract enabled, there was no activity. There was no applications in those first couple of years. So when those models were done, they came up with pretty strong relationships between that definition of Metcalfe's law and the market cap. But the space has evolved. If you look at smart contract platforms today, they are multi-layered, multi-nodal, multi-dimensional. There is a lot more activity happening. There is the settlement layer, then there is the application layer. So there's an economy that's growing up around on top of it. Then you've got, obviously, the validators are an important part that secure the network. So the approach I took was like, we need to think, and also let me just sort of point out what the issue is with daily active addresses. Like most people would admit, like across all metrics in crypto, let's be clear, there is a lot of manipulation and there is a lot of fake activity. There's a lot of spam, there's a lot of bots and so forth. I've tried to research as much as I can on how to quantify that, like what percent. I've gone out to the data providers, they don't know. There's been published reports that put it somewhere between sort of 5 and maybe 15 or 20%. There's just no comprehensive data on it, unfortunately. But let's assume it's there, and let's assume it's probably uniform across all the assets. Does activity on the chain still explain the price, even if you take that into account? Yes, it does. But what daily active addresses does in isolation is that it explains less and less of the value now. So there had to be a better way to model activity on the network rather than just daily active addresses and like how much value is transferred. So just taking that sort of multi-layered approach, I created something called the ENI, or Economic Network Intensity. And this is going to change, it's going to be updated, but like the initial approach was like, let's move beyond daily active addresses, which we all understand is problematic, and incorporate things like how many validators are actively securing the network, and then how many applications are actually generating revenue on the network. And then you get a much more, I think, comprehensive view of the multi-layered smart contract platform ecosystem. When you do that, at least from my analysis, and you do it at the aggregate level, right? So this is analysis done on all the the major smart contract platforms, layer ones, in aggregate. And what that did was it pretty much improved the Metcalfe's law model significantly, from like explaining 50% of the market value to about 70% of the market value. But it doesn't end there, and you should never hang your hat on just that one thing, because there's a lot more going on. But I did, in that paper, I talked through the reasons why it's a sound foundation. I did it out of sample and in sample. So I looked at just the last 2 years and looked at how both models perform, and they both degraded. So they both explained less about this last 2 years than the previous 6 or 7 years in the backtest. But the ENI model, my model, stood up, actually didn't degrade as much as the other model. In fact, it still explained over 50% of the market value, even through this very, very choppy and different type of environment that we've been in. Whereas the daily active address model basically crashed to have no relationship. So you discard that, and let's move on and start thinking about these assets as more sort of like, ecosystems with a network intensity that better explains why there's value to the underlying asset. Now, the question everyone should ask is, okay, over the last 2 years, it explained about 50%. So what explains the other 50%, right? And that's where the research needs to take me next. It's need to look at, for me, I think supply plays a big part. My thesis all along was like, not only Metcalfe's law that these are sort of network assets, but the activity on these chains is distorted by the supply of the supply aspects, the tokenomic aspects. Huge overhangs, large FDVs versus market cap, unlocks, and high inflation rates either distort or destroy activity. And so my view is that over time, this metric should explain more of the value of these assets as the unlocks start to wind down and as the inflation rates start to come down, and you get a more clearer read. So there is much more that needs to be done on that side of things. And then there is one more aspect to the value of smart contract platforms, which I think is important, is there any monetary premium in the underlying token? And the way you can think about that is like how much of that token is being used in the DeFi pools as collateral, because that is effectively someone saying, I think this is a store of value enough for me to risk it as collateral to do other things with. And then you can sort of measure how much of it's being used in those ways, what sort of utility it has. And clearly Ethereum has monetary premium, but a lot of the other tokens don't. And so that sort of explains some of the disparities, but it's all part of like a long-term project to try to get a better read on how these assets are priced.
Stablecoins are the biggest use case in crypto right now, but let's be real. Using them on chain is still way too complex. That's exactly the problem Bridge is solving. Recently acquired by Stripe, yep, that's Stripe, Bridge helps businesses send, store, accept, and launch stablecoins instantly. Explore the future of global financial infrastructure at milkroad.com/bridge.
That's valuable work, man. I like that. I think that's a sophisticated approach, and something that's desperately needed in the space. Is just something more evolved. One thing you noted in your report is Solana's score, and you said that Solana actually may trade like quite accurately to its fundamentals. I think that's an interesting take, especially that you mentioned that. You mentioned potential like fake wallets and may not represent real users. Solana being a landing spot for that with so many meme coins and so much of that happening. Tell me a little bit more about that evaluation of Solana.
Well, because it's being used, there's a couple of things, right? So the analysis looks at a whole bunch of like these top 10 L1s. And you rightly pointed out, like when you rank them on this methodology, Solana actually fits this methodology quite well. Ethereum doesn't. And so I've sort of talked about where the discrepancies are and potentially areas of new research. But my thesis is on why I'm seeing that in the model is that, firstly, Solana's monolithic chain, right? So it doesn't have L2s that are distorting the activity or leeching activity away is probably unfair on Ethereum, but there's like activity that's happening off chain, off the L1 that relates back to the L1 settlement fees, but it's a direct or indirect sort of distortion, depending on where you look at it. Solana doesn't have that issue. The other issue is that Solana is used. Right? There is activity on that chain, and also it's much more further into its supply overhang. So I think maybe there's like 15 or 10 to 15% left until all the unlocks are finished. And so you're starting to get a much clearer read. Now, there's other chains that are sort of in the same picture, like Near has basically got no overhang, but it has very little correlation to this model. So there's something else driving those particular assets. And clearly, if you look at Solana's activity, the number of apps that are being built on that chain versus, say, Near is dramatically different. So I just think that, if a chain is successful, it will grow into this model because the economic activity is not being distorted. And number one, and number two is there actually is economic activity. So if there's no economic activity, it's very hard, and it's multi-layered, and it's very hard for that model to fit it. So it is somewhat aspirational too. Like, this is where I think we'll get to over time with how to model these networks. But like, then just some of these chains are, like if you look at Cardano, like there is no explanation in my mind why it has the valuation it has, given the economic network intensity of the asset. And that again is the flaw of the model potentially. Like, what are we missing here that gives Cardano value? It's going to be a fertile area of new research.
Oh man, I was hoping you would be able to explain away some of the great mysteries of crypto, but looks like there's what's nice is that you have a good model. It's working in some cases, but there's clearly plenty left to be discovered. Let's put it that way.
Yeah. It's everyone, this debate that's going on at the moment, which is like the number one debate outside of whether treasury liquidity is better than central bank liquidity. The other one is like, should these assets be valued on something like a Metcalfe's law or Steve saying, TVL? And I think it's good. Like, I think it's really, really healthy. Everyone's got their views, and, we're, Twitter and the open platforms that we still have left in the world are great places to thrash out these ideas and hopefully get to some source of truth.
Mm-hmm, mm-hmm. Especially as more L2s are released and, people continue to wonder about the value of Ethereum, which is clearly, the one that suffers the most from having so many side chains, right? So I think that's something that is very helpful to have in the ecosystem. Jamie, I think we're going to wrap up there. I think we've loaded a lot into less than 40 minutes, man. It's been great to have you on, and thank you for coming back on Milk Road.
Yeah, it's always a pleasure. Thanks, LG.
Want insights on what's moving crypto markets and how we're trading each event? Subscribe to our channel and join the Milk Road Daily and Pro newsletters and start investing like the top 1%. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.